on TV, online and on your smartphone. This is Ticker News.
You are watching Ticker today. I'm Aaron Young, and if it sounds bad, it probably is. Today we are discussing rising interest rates, the impact it's having on mortgage holders, the property market, as well as people's mental health. It is so stressful out there at the moment as people are essentially trying to determine what they need to buy, what they have to do, and what they can get rid of to be able to pay things as they are seen. For more, we're joined by Will Banks of Shillings Capital. Talk to us about the amount of mortgage stress that's out there and what has happened over the past year.
Yeah, there's a huge amount of mortgage stress. It's thought that a quarter of mortgage holders are already in mortgage stress already. What does that mean? It means that the home owner has more than 30% of their income going towards mortgage payments. So to put that level of stress into context, a $750,000 loan has now gone up $1,500 a month. So as a family, you would need to generate an additional $25,000 pre-tax income to be able to cover that. And that's due to those 12 hikes that have taken place since April of last year.
The impact on households to try and find $1,500 extra per month, with the uncertainty as well of what is coming at a time when the unemployment rate, things are getting really tough out there. We know that the RBA won't be happy unless more people are unemployed. Maybe not happy, but they won't start to bring rates down. Talk to us about the amount of stress that in itself will be putting onto people.
Well, I think there's actually there's a hidden issue. Which is on top of that, which I don't think is particularly being spoken about, is that first of all you've got the serviceability buffer on top, which is restricting people from being able to move into more competitive products. The second point is where they are now.
The minute you walked in the joint, I could see you were a shopper of distinction, a real big saver.
Big saver. Save on hundreds of products with Nectar prices at Sainsbury's. Simply scan or swipe Nectar in store or online.
Now refixing mortgages from a sub 2% to a plus 6%. That's going to cause them stress. And they will end up being put into a position where it may be completely unaffordable, so they're forced to sell. And therefore they may have to sell at a loss. And not only that, it means that the products that they've then got into will have early redemption fees, which could be $40,000. So before they know it, they've refixed a mortgage which they can't afford to pay, pushing their property could be then pushed into negative equity, and then it's going to cost them $40,000 to then get out of it. So I think there is a huge hangover with regards to all of these mortgage rate increases, the amount of pressure it's putting on the economy and mortgage holders.
Property prices somewhat boomed during the pandemic. They've settled a little bit, but what would happen to property prices around Australia, indeed around the world? This isn't just an issue which is impacting Australian prices as well. What would happen if all of a sudden you have a huge number of people, something like 1.4 million Australians in a country of 25 million are starting to struggle? What would you see as the impact on the property market should this materialise where people just simply can't pay?
It happened in the US during the GFC, where there are huge areas of America, especially around Detroit, where you had houses that were being sold for $1,000. I think, though, having said that, I do think that it is stressful, it is difficult, but I do think that the Australian economy is moving into these headwinds in a much better position. So I think with falling prices, obviously, you only get impacted by those falling prices if you realise it. If you're able to hold on and deal with those rising interest rates, and then when they come down, and they will come down, then
the minute you walked in the joint, I could see you were a shopper of distinction, a real big saver.
big saver? Save on hundreds of products with Nectar prices at Sainsbury's. Simply scan or swipe Nectar in-store or online.
It won't be a longer lasting impact. The issue will be is where you can't afford it and you're forced to sell, pushing you into this negative equity position.
I've spoken to some who believe there may be 4 interest rate decreases next year, drops in the rate as the RBA tries to pump up the economy again. It looks like it'll be a difficult few months. There will be some who will be holding on to that, hoping that that's the case, but the risk of kicking the can down the road and continually going into more debt, trying to pay off debt, whether that might be personal loans or credit cards, to be able to get through this, winding down your savings too, that's a pretty bad state for a lot of people to be in.
Oh, hugely. And the thing is, there isn't any certainty. I mean, I believe that interest rates will go up at least another 2 times this year. But at the end of the day, nobody actually knows. And nobody knows how long they're going to have to survive in this current situation. So if it was clearer that there were going to be 2, 3 or 4 rate rises, but actually we knew that within 18 months those rates were then going to stable out and would come down, households will be able to plan for that and be able to budget. The difficulty is they can't do that. So I do think that the banks do have a level of responsibility. And don't forget, it's part of their licensing as a bank that they have to treat customers fairly, and they can't put them in a position which would be incredibly stressful. They have to work with them and try and resolve these issues.
All right, we'll leave it there. Will Banks, really appreciate your time. Thanks for talking to us. All right, and that is the program for now. For more, you can head to tickernews.co. I'm Aaron Young. I do hope to see you again soon.